अरे मौका बिना फिक्र के जीने का मिल गया। 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया। जो आने वाले कल की प्लानिंग करके चलते हैं, सोच समझ कर उनको इन्वेस्ट करने का सलीका मिल गया। 12 20 और 80 से पीस ऑफ माइंड मिल गया। म्यूचुअल फंड में इन्वेस्टमेंट करने का तरीका मिल गया।
Finally balanced, active, passive, index or managed, सभी का मिल गया।
क्वांटम के म्यूचुअल फंड, क्वांटम के 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया।
क्वांटम म्यूचुअल फंड के 12 20 80 यानी 12 20 80 एसेट एलोकेशन अप्रोच ने इंडिया को सिखाया इन्वेस्ट करने का सही तरीका। और जानकारी के लिए सर्च करो क्वांटम 12 20 80 एसेट एलोकेशन। म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को सावधानी से पढ़ें।
Good evening, everyone, and a warm welcome to the webinar. My name is Neeraj Kotian, and I'll be the moderator for today's webinar. I'm part of customer interaction team at Quantum Mutual Fund. First, let me thank you all for taking out time on Wednesday evening and joining us for the session. We'll request everyone to use their headphones for better audio clarity. Session will have approx 30 to 45 minutes of presentation, and then it will be followed by Q&A. You all can post your questions in the chat box once the presentation is over. As you all know, the topic for today's session is, are market dynamics supporting value investing? So value investing focus on quality companies trading at discount to their intrinsic value. Intrinsic value is a measure of what an asset is worth of. Warren Buffett called this intrinsic value the only logical approach to evaluating the relative attractiveness of investments and businesses. But under the current market scenario, with high inflation, tightening liquidity, and looming recession, is value holding the center stage as a true hero? That's the question we all might have. Hence, in today's webinar, our fund manager will decode macro uncertainty, share 2023 market outlook, and answer the big question about whether value investing is truly supporting the market ecosystem or not. So before I hand over the control to our speaker, let me introduce him to you all. Our speaker for today's evening is Mr. Christy Mathai, who has close to 7 years of experience in equity research across multiple sectors. He's a CFA charter holder, and presently he is the fund manager for Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. So without taking much time of yours, we'll request our speaker to take her at the session. Over to you, Christy.
Yeah, thanks, Neeraj. Hope I'm audible and the presentation is... Yeah, thank you. So thanks all the participants and dear investors for joining and taking the precious time to join us for this webinar. I've titled the talk today as our market dynamic supporting value investing. It's a very pertinent question in the current environment that we are in, which is characterized by, across the global landscape, high inflation, rate hikes, and slowing growth. So what we'll try to do today through this presentation is try and understand if value can hold through this environment and beyond. So just to begin with, so I just like to lay out the economic backdrop that we are currently in. So if we look at the table on the left-hand side, which is broadly the GDP growth rates across, DMs, which is developed markets, and some emerging markets, including India. So this is the CY23 GDP estimate by consensus across these markets. And what we are seeing is a deteriorating trend in terms of estimates. That is, if somebody were to estimate CY23 GDP sitting in Jan 22 versus him doing it in April 23. So we see a marked deterioration, except, few countries, something like a Japan. But broadly, this is a deteriorating trend. And this ties in well if you look at the policy action across, the global world. The policy in US, for example, the Fed has kind of rate hiked to the extent of 2.7%. And similar is UK, Eurozone, Japan being the only exception. And across the emerging markets also, there has been substantial rate hike. And the broader reason, as you all are aware, it is primarily because of the inflation that we are seeing in across the markets. So the impact of this in most of the developed markets is a slowing GDP. So the growth has to be, in a way, subdued for them to get the required inflation objectives, if you were to think of it. India, in a way, is an exception because, and even in some emerging markets, because the policy rate pre-COVID also was quite high. So for us, it's kind of a normalization in terms of interest rate, despite the quick rate hike that has happened over the year or so. Also, what we are seeing, India being an exception, because we are seeing very good, ground level growth. If you were to think about government capex, private capex is picking up. We have all-time high GST collections, which we have not seen before. We have, utilization up move in bulk of the industries that is happening, and also a real estate revival in that sense. So for India, it looks like we are in a capex upcycle, and this ties in well because if you see from 2013 to 2020, it was a period of very slow growth in India. It was a period of low growth in that sense. So growth is just getting normalized, in this upcycle, if you were to come to think of it. So, the key reaction to this degrowth is also how the markets have reacted. So if you were to plot 1 year, returns across emerging markets, across developed markets, we see a downward trend. It is down to the extent of anywhere between 5 to 10% in USD terms. And India is also in line with that. It's down by 6%. So there is this interest rate induced lower growth because of inflation that is being absorbed, and that is the economic background kind of what we are in. And also, if were to put this, the yellow line here, it kind of plots how this is MSCI EM World Index, categorized in value and growth, the different styles of investment. And if we were to plot it against the US 10-year yield, how that is panned out. So what we see is a clear trend where value is kind of catching up versus growth. And India, it is even more if you were to look at the chart. The value style is fast catching up. And the key reason for this is, when there is an uncertain environment, when there is a sharp reduction in growth rates across GDP, and this is to be reflected in some of the companies' results as well, this risk on environment value kind of does quite well. And also, this interest rate normalization that we are seeing is almost a 14-year reset that is being seen. And there could be a case that maybe somewhere in the later half of the year or next year, there could be the rate hikes would stop, and there could be probably cuts. But as a whole, the rates would settle somewhere above pre-COVID levels in the foreseeable future. So from that perspective, also the cost of capital reset is is a large shift. It's a fundamental shift that we are seeing. And if were to come to think of it, it has certain repercussions, if you will. It's the case in point is some of the banks in US which were currently in news the SVB Bank and Signature Bank and few of these mid-sized banks which ran into trouble uh, because of this fundamental shift that we are seeing. So what an interest rate hike environment causes is all these fragile, weak business model, they are in a way exposed. Also, what we have also seen is a reset in valuations in many expensive pockets. It's quite logical that when the interest rate moves up, these high growth, where we are building high growth into projections, into EPS growth and so on and so forth, their value substantially comes down when the interest rate hikes. So two things that we are observing, these shaky business models are coming to light, are getting exposed, and also the valuations are being reset in many of the pockets, including Indian markets, right? So I would define value and how we look at it, but broadly, for your reference, the way we define, value as an approach is we are trying to buy companies which are at a reasonable discount to their fair value or intrinsic value. And this value, style is being reflected in our value category, characteristic, if you were to plot it against a benchmark. So that's how we define value, just for, all the investors, awareness. Coming to, the flows, which is another key driver of the market. For the past 5 years, we have seen, especially after COVID, there was this, inflow from FPIs and DIs that came in. But over the last year, we have seen substantial redemption, especially on the foreign institutional part. And that trend continues, even YTD. So in the past, what we have seen is any such sudden, up move or down move would really move the markets quite a lot. But now there is this DI absorption capacity, which is kind of increased, and it has to do with, us as being retail investors trying to invest more into equities. So that is definitely picked up. There is increased flow through, the pension funds, which were not earlier allowed to invest into equities, but they are now allowed, and there is increased insurance activity. So these kind of are the levers by which the domestic institutional investors have been able to kind of support the market despite the FPI redemptions. But these actions do give opportunity for somebody like a value manager to take advantage of the mispricing in the market. That said, there is a common, in fact, there's a myth that if you come to think of it, India is a growth market, and the popular perception is, what is a value manager really doing in a growth market like in India? We should be paying, buying into those high growth stocks, with whatever PEs, BVs, whatever, the high valuation. So we should be looking at those stocks and what is the value manager doing in India? But if you really were to look at this data, this is MSCI India, value versus growth chart, and the green is MSCI India value, and the red chart there is MSCI India growth, and MSCI India index is somewhere in between. So if you were to look from a very long-term perspective, value as a style has kind of done well against growth. It is only in the past 10 years where there was, in a way, absurdity with respect to the interest rates, especially in some periods, that kind of moved the needle. And given the interest rate reset that we have seen, we can expect the value to dominate in the foreseeable future. So just coming to this question, why does, what are the the characteristics of the environment that we are in that sort of helps value as a manager, and what's market and macro environment helps growth as a style, right? So because in a way both are very cyclical. There is 5 years of value outperformance, then followed by a substantial time where growth as a style did well. Now it's just again a reset that you're seeing. So one is, of course, a macro environment that one can be in a value really tends to do well when there is, a capex cycle which is kind of doing well, and there is a credit cycle which is taking off. So in such periods, there is a broad-based growth recovery that happens in the economy, and hence, value in those environments have typically done well. Growth kind of does well when there is a commodity deflation. The crude has been at its lowest. If you were to plot a chart of crude over the last 10 years or so, so there was and that was a big commodity deflator in a sense. And periods when monetary policy kind of prevails over fiscal policy, where there is the central bankers can keep at those rates substantially low, which induces more risk taking into riskier assets. And so there is no cost to capital in that sense. So those are the environment where growth can do well. And as I showed you that flows chart, so India has a history of going through bouts of optimism and pessimism, especially on the FPI, foreign institutional side. And when that happens, it generally presents us an opportunity to buy into, to kind of take advantage of the mispricing that is there in the market. And also, whenever we model any company, or whenever we think of any company, we are trying to look at the normalized earnings that it could deliver over 2-3 year period. And business cycles has its own ups and downs. And we also try and take advantage of the mean reversion that can happen either in multiples or in earnings. I'll illustrate it with few examples. So a combination of these, if you are very disciplined with respect to process, you have a long-term outlook in terms of the view of the company, view of the, the macro environment, and pretty reasonable normalized assumptions that helps us to be able to, position our portfolio appropriately in any environment that we are in. So, so I'll just kind of talk through a couple of examples that we have, witnessed portfolio, and how we have gone about capturing some of these opportunities in our portfolio. So case in point is the information and technology sector. We have been, invested in the sector for quite a long time. And there was a period that which was like FY 16, 17, even part of 18, when people were really writing off Indian IT services. And the key reason was there were a lot of new technology which were being adopted. It was called SMAC, if I remember it right. And somehow the investors of the view that the Indian IT services companies would not be able to adopt to this change in technology. They would not be able to reskill their existing manpower to, take advantage of the opportunity that present. And they were at high risk of obsolescence. And hence, there was a substantial derating in terms of multiples. And also, earnings did not come through because these, companies themselves were going through the shift. And so we saw an opportunity in IT services during that time, because of course the managements in most of the companies were extremely dependable. They had, over a period of time showcased how to really run a company, how to execute well. So we were very confident of the management ability to execute, especially if you were to think of the large cap space in the Indian IT services. And Indian IT services generally are efficiency drivers in bulk of, their clientele being Fortune 500 companies across the globe. So they play a very important role in terms of driving efficiency. And so in a way, you cannot really discard them or, do their job by either by insourcing or to giving to certain extremely highly digital companies. So they have their own, strengths in that sense. So if you see our weightage, sector weights, across this period, so we build a position over a period of time. So, it went about from 9.5% in terms of IT sectoral weight to almost like 17% in September 18, because we thought this period, was a good accumulation phase. And, the performance during this time was, at best, the IT index really underperformed versus BSE 200. But if you see the period afterwards, so there was a substantial re-rating for the sector. The earnings growth came through, the multiples came through. Multiples also got re-rated. So in that sense, so certain mispricing due to whatever view due to disruptions could be of advantage when we come to think of for a value manager to take advantage of. The other sector that I want to talk about is pharma, again way back in 2015 to 18 period. So this was after a phenomenal run that pharma had, starting almost late 2010 to 2015, where the growth rates, there was margin expansion, and it did very well. We were not very comfortable with the valuations back then, so we almost had nil exposure to the sector as a whole. But over a period of time, what we see is, over the next 1 or 2 years, that there were a lot of issues that cropped up within the pharma bucket. One of them was, there was a consolidation in terms of buyers, because Indian pharma players are exporters to US, in substantial measure. So they almost export close to what, $20 billion dollars of generic drugs to US YOY. Every year, and it keeps increasing. But on the other side, that is US, there was a consolidation in terms of the buyers of these drugs. So there was a substantial pricing pressure which hit the India pharma names. Plus the FDA inspections, across various facilities garnered pace, and there were a lot of notices that were given. So certain products which were to be filed got so there was an entire revamp they had to do of the facility. So the pharma had a very tough time during this period of time, and we thought there would be opportunity because this pricing game would ultimately settle at some price, and the Indian pharma would get efficient in that sense. And once they understand how to go about this US FDA issues, they would change in terms of their plant mechanization and so on and so forth. And we see that there was a pain period lasting until 2019, but from 2019, the pharma index kind of has done well, and our weights have also kind of increased, during this pain period. So we kind of take advantage of, this mispricing or, near-term issue that can crop up in any sector to build it for the long run. Lastly, there is obviously a focus on corporate governance, which has been, the hallmark of, our investment process, that we developed the integrity screen, Ajit and Subbu, way back in 1996. And we weed out any companies which is, either it is shaky in terms of governance, it have grown because of government patronage, and has access to funds because of that. So it has always been our focus. So in value investing, apart from the catalyst that we are looking for, it is extremely important for us to have a view on the management, to be comfortable with the management that they will deliver on what they have promised, and there is no major corporate governance issue in that sense. So I just like to talk about two sectors which kind of did extremely well in their heydays, but when the episodes of corporate governance, of risky growth came to fore, they had a dramatic fall. So case in point is the infra boom that we saw in 2004-8. So this was a period when India was, part of the, there was this BRIC madness where they expected, the BRIC countries to do meaningfully well. The GDP expectations was somewhere around 9 to 10%. That was what the growth expectation was, that was built into, Indian GDP story. And one of the beneficiaries were, of course, the infra players who would go about setting up, various plants, various roads, etc., etc. So we see a euphoric rise, and at this point in time, we had grown very uncomfortable with, this whole pack sector as a whole, and we were sitting on cash, not investing or participating in this boom. So there was a pain period that was involved. So if you see the movement of the index itself, so it moved all the way from 2.2% in 2004. This is infra stocks as a percentage of the BSE 200 to almost 8.2% in 2008. And this is when, the GFC crisis came to fore, and there was liquidity withdrawal in that sense. And they had no capital to grow. And what we see is a marked, decline. Many of these stocks, which were like part of the indices, the major indices back then, have become kind of penny stocks over the, subsequent periods. So this is one of the, major red flags, and we tend to avoid such sectors, where there is market bullishness, but weak corporate governance. The other example is, of course, real estate. And this also had, a brief, in a way, a brief run, because it started somewhere in 2007 and ended, on the onset of GFC crisis. The weight again moved from 0 to 3.3. Here again, the expectation was that India would mimic something like what is happening in Hong Kong and other markets, where there is a sudden explosion of real estate. And as a result, a lot of companies with shaky governances came to fore. They IPO'd. There was dramatic value that was attached to certain land banks. But again, what we see is that, dramatic fall in the subsequent periods. So it's extremely important to have a catalyst and to also have a management whom you can trust with your investments. In that sense. So also, we get asked this quite often, that does paying high multiples really work in India? In a sense, like, because India being a growth market, so it is assumed that a good quality company will always be priced to perfection. There'll be and it is worth paying that because of the quality that there is. So I'll just like to clarify that we are not averse to owning quality companies. In fact, we would welcome them, but it is just what price are we willing to pay for that growth. And so a classic case is the FMCG sector as a whole, which is, of course, very high quality. They have amazing return of equity. Growth rates have been very good. And over the past 10 years, what we have seen is a lot of margin expansion, as they have been able to execute so well on the supply chain with respect to price hike and so on and so forth. But BSE 200 in the past 10 years or so have kind of beaten, the index itself has beaten the FMCG index. And despite, if you were to think about the market multiples that FMCG commanded, it would minimum upwards of around 40 plus, and BSE Sensex is probably less than half of it. So paying, and this is the best of best sectors in terms of quality. So the entry price is extremely important. And hence, we go back to the fact that we want to own good companies at reasonable valuations. Another example is, the startup meltdown that we witnessed starting last year or so, November 21. So what you've seen is that suddenly there was a big liquidity gush, post-COVID, and, all the startups, in a way, late stage private equity companies were flush with a lot of cash. And then, their CEOs overnight became sort of billionaires in that sense. And then many of these companies went through the IPO process. But if we were to plot the performance against, the BSE 200, after, they all came to IPO around that same time, that is November, December 21. There have been substantial value erosion with respect to the index. If you were to put in money in index, BSE 200, so the return, it would be somewhere around 95, 96, if I get that right. But the startup sector, in that sense, the listed players who recently IPO'd, much of them are trading below 50 in that sense. So there is immense value destruction that has happened, and they were all IPO'd with crazy multiples, with no profitability in that sense. So it's very important to be cognizant of the multiples that one is according to any sector, right? So how do we define value? How do we go about our portfolio construction, stock selection? I'll just like to briefly take some moment to explain this. So, uh, so for us, it is very clear that we have this integrity string that we developed it from 1996, where we weed out companies who have suspect managements, as I've already spoken, especially political linkages, where they've been favored, with access to capital and so on and so forth. And these companies can be part of indices, and we have gone through a period of where we were underperforming quite substantially because of not owning some of these names. The other is like on valuations that I spoke. So we want to buy a stock at a discount to its fair value, or what we think is fair value or intrinsic value. And therein lies a margin of safety. Apart from the strong business model that we would like to buy, the margin of safety also comes from this movement where this discount rate gets reduced to its intrinsic value. And lastly, we also need a definite catalyst. We can enter into certain value traps if many of the companies are trading very cheap, but necessarily it remains cheap for a very long period of time because there is no catalyst that will unlock that value. So it's very important that even as we go about selecting a stock, that it has a defined catalyst that we are constantly monitoring, and it within the valuation that is comfortable to us. Right. So also, this is how we just go about, this is our portfolio construction process. We evaluate a company, we try and meet the management as often as we can to understand their thinking strategy. Each of our analysts who's respectively tracking a sector is expected to build out detailed models, 5-year projections, 5-year historicals, and very important for us is to build a normalized earnings. So for example, if a sector is just coming through, so case in point is something like an IT services, wherein we saw in the COVID period, a lot of margin expansion, multiple expansion, growth coming back. But when we are building in our 2-year, 3-year number, we are trying to normalize it. And same is the case with any industry which has gone through a down cycle, where we have confidence that their intrinsic value is much higher. We try and model a normalized earnings 2 years out, which is because we believe in mean reversion of economic cycles for that company. So each of our analysts kind of build in this, and we kind of freeze our valuation bands. It could be PE, PB, EV, EBITDA, or DCF valuation that we might employ to look at that valuation aspect. And as I said, we would at least like to have a 40% discount to our intrinsic value when we enter the stock first time. But some of the industries we have seen, they have never traded at such deep discount. So in those cases, specifically, we narrow it to about 25%. And our sell decision is very clear. We evaluate a company whenever the stock hits our sell limit. We look at it, we review it again. If there is any thing that we are missing, if we don't find anything missing, we straight away exit the stock. And in some cases, we exit it gradually. And if there are other better alternatives available at that same point in time, and so these are some of the considerations that influences our sell decisions. So liquidity is an extremely important criteria for us, because what we have observed is outside of the top 250, 300 names, there is no liquidity, very little liquidity to enter in and exit without an impact to our NAV. So we define this $1 million minimum as a trading volume for a stock to have, so that it gives us a smooth entry exit without much impact cost. So there are about 700 stocks right now in the industry in the stock market. So many of them would have some governance issues. Some of them would not, they would not meet RR. The threshold in terms of financial metrics and so on and so forth. So we weed all of that out. So by and large, in our database, we have a live and buy and sell for about 200 stocks, which we kind of very actively track. And out of this, we, around 25 to 40 names come into our portfolio. So this 25 we are generally at the lower end when we do not find much opportunity to deploy. But in a period like GFC or during the COVID crash, so suddenly we can deploy into many more names because they come to our buy price. So that's how we go about the portfolio construction. And lastly, I would like to also talk about the process itself. This is called an upside chart, and this is very crucial for us, for everybody to understand our process. So at every point in time, any stock that we have in our portfolio, we have a live buy and sell price, and generally the upside is the difference between the current market price of the stock and the sell price. And if you were to do it that for the entire portfolio and weight it with respect to their weights that is attached in the portfolio, you would arrive at a portfolio upside potential. And what we have done is the saffron line is actually the our 2-year out projected upside potential, and the blue line is actually realized NAV of of the portfolio. So what we have observed is that our expectation, what the portfolio will deliver, and the blue line, which is the actual data, is quite close. The NAV broadly tracks very closely, barring certain global dislocations. For example, during GFC, during the taper tantrum that we saw in 2013, during the COVID crisis, there was this period of growth doing extremely well. So there was some divergence there back then. But barring this showcases that, at least the analyst numbers and the process kind of works. They're mostly in line. And there is predictability that is attached to the portfolio, even as we go about constructing the portfolio. So this is how the the portfolio is currently positioned. So we are kind of overweight on discretionary, financials, utilities a tad bit, and on infrastructure marginally, IT, information technology marginally. So from a consumer discretionary is for us the auto pack mainly, and we are kind of overweight on the two-wheelers. Some of them have done extremely well. Few of them we are expecting the catalyst to play out, especially in two-wheeler, rural, exposures. Within financials, we think, India, the portfolio is kind of well positioned for that capex revival when that will happen, and financials are, will take advantage of, the revival whenever it happens. The corporate book of most of the lenders have stayed kind of stagnant, barring this year there is some growth. But there can be a big upside to that, even as India enters the capex cycle for the financials. And more recently, we have been able to get into the savings link theme also for the many of our funds. So we have been able to get exposure to certain brokerages, certain AMCs, insurance companies. So it's a broad mix of all these names. And within utilities, we think we have exposure to certain companies within the power sector, CGDs, where we think there is a future, bright future in the next 2-3 years. So again, this is the portfolio construction. So this is again extremely important to us. So it is very important for a portfolio to depict the value characteristic, because it's a value fund. And if you were to look at our dividend yields, it is much higher than the index, 2.2 versus 1.4. Our price to earnings 2 years out is much lower than, it's a steep discount to the index at 11.3 versus 15.9, about 30%. And our growth is a tad bit lower, whereas our PEG ratios are superior, 0.68 versus 0.87. So our kind of portfolio has been consistently able to demonstrate a value character bent, even as we go about portfolio construction. And these are our returns. It's kind of available on the fact sheet. So past 1 year, our performance have kind of improved, even as value as a style had made a comeback. 3 years, we are kind of marginally trailing the benchmarks. We think, and then we think, even as this value as a style does well, and our companies which is well positioned for the cyclical upturn that we'll see in the economy, performance can be better. Yeah, so I think I'll just stop at this point in time, and I'm open for any questions. Yep.
Thank you, Christy, for your insightful presentation. We'll request all our listeners to post their questions in the chat box. In the meantime, we have already received a few questions via email before the webinar. So we'll start with that first. Christy, my first question to you, like how can an investor identify a value fund among other types of equity mutual funds?
Right. Yeah, it's kind of a very pertinent question, because like all other styles have been clearly defined, styles. For example, if you have a large cap strategy, if you have a mid cap strategy, so it's very clearly defined, what can go into the portfolio. So it's very clear, SEBI has put up clear, exposure limits for each of those, kind of funds to be in that category. But for value, it's a bit tricky because there is nobody who has kind of defined that sector, that particular category as a whole. So our definition, I'll just go back to, this particular slide, which kind of showcases the portfolio characteristic. Typically, any value style should be ideally cheaper than the index, and this characteristic should be consistent across different market cycles. There could be, because suddenly value is the flavor of the market. So, people can display that value characteristic, so that can happen, but you have to be very cognizant of the fact that the style has to be maintained across cycles. Some of the characteristics that I mentioned: higher dividend yield, lower PE with respect to index, higher lower peg ratio. So all these are characteristic of a value fund which you should investigate, and there is enough and more data to look for these all these parameters. So if you were to grow by this, and if you can consistently compare it across market cycles, it will clearly showcase which is a value fund, which is not, and so on and so forth.
Second question, Christy, how do economic and market conditions impact the performance of value funds, and what strategies do you use to navigate this fluctuation?
Right. Yeah, so again, I'll just go back to this particular slide, which clearly defines, yeah, I hope this is clear. So, the times when value can do well, the times when growth can do well. So I've gone through it, right? So here we, there was this period between 2016 to 2019 where even a slight beat on growth or a slight, outperformance with respect to their, sectoral peers for any company were richly rewarded in terms of valuations. And that is why we saw that valuation really move up during this 2016 to 2019-20 period, which was very good time for growth investors in that sense. So there was a valuation premium which was accorded to a minor growth, outperformance, or a minor margin of performance, and so on and so forth. But what you see in the current environment, this has kind of reversed. Pre-COVID it was like that, but post-COVID, what you've seen is now there are enough and more opportunities. There are a lot of companies which are displaying broad-based growth, and suddenly this valuation premium which was accorded has suddenly disappeared in many of the expensive pockets, right? So so this is the nature of the market, the nature of the environment that we are in. And the major difference is here was that was a low interest rate environment, this was a high interest rate environment in that sense. But by and large, we think a value as a style will do well when there is a credit boom, there is a growth, the investment cycle is kind of picking up. And growth as a style can do well when, the commodities, raw materials are, it's a deflationary environment in that sense. We saw that with the likes of many chemical names, in across the market. Suddenly, over a 14 to 17, 19 cycle, the crude was trading at much lower prices with respect to historical averages. And we saw them being able to maintain margins, them being able to expand margins. When we look at the other side of it, when the crude, moved all the way and it was very volatile during the current environment, we saw the margins coming under tremendous pressure and some of them not being able to recover. So suddenly, these vulnerabilities start creeping in to some of these growth companies when, things turn the other side. And also, lastly, as I said, when monetary policy has an outsized impact compared to fiscal policy, that is the environment where growth can do well. Yeah.
Thanks, Srishti. There is one stock specific question, but you can talk as in sector wise. What's your view on the insurance sector, basically?
Yeah, sure. So insurance, if you were to, so this is one of the classic examples similar to what we've seen in FMCG ever since their listing. Many of these insurance companies were priced to perfection, and there was absolutely nothing could go wrong in terms of whatever the premium valuations were recorded. So growth was extremely high for these companies, and what you've seen in the current environment, when there is so much of regulatory uncertainty, especially around how a regulator thinks, he keeps tinkering around with so many aspects across general insurance companies, life insurance companies. Suddenly the valuations have kind of come off. They've been a big derating environment for the past 1.5 years, if you were to think of it. And this is where, we come in. We have been through that period of outperformance, through that period of extremely periods where the valuations are recorded so high. We were really studying these companies to try and understand the strength of the business models, the market opportunity, trying interfacing with the managements. And see, these are all solid businesses, but the point is, so many things, if you're not on the right side of the regulator, that can impact you. So currently we are finding some opportunity within these pockets. And we think while the near term can be a bit shaky in that sense, but given the opportunity that some of these companies have and the valuations which have kind of come down, it makes us interested in some of these names, in starting this year. Yeah.
Thanks, Srishti. There's one question on the star ratings of our fund. Like, as I understand, the stock pitch should have lower fall in difficult times. But if you see in our other financial website, long-term equity value funds has been rated as 2-star performance. So any comments from your side on that?
Yeah, so I think some of them look at near-term data to, get the star ratings. So, and there is no denying that we have had a tough time, starting 2016. If you were to look at our fund performance, before 2016, we were there in the top 5 across categories, in any comparison. But the performance has been issue for, and 2 years have, hit us extremely hard. That is 2017 and 2019. And, we have had substantial underperformance because of these 2 years. But incrementally, the past 1 year has been good, and we think our outperformance can sustain with respect to indices. So even as that performance comes up, some of those ratings also should change. That is my view. And if you also were to look at the portfolio construct now versus then, so that was an environment where we were struggling to find opportunities because of the valuations which were absolutely beyond our control. So we ended up owning quite a few of the PSUs, which of course had a catalyst, but there were certain regulatory interventions which kind of delayed it. And what we find increasingly is we find a lot of quality names which are coming in our valuation band. So in that sense, hopefully the performance should be much better than what we have been in that cycle of 2016 to 2020. Yep.
So thanks. Next question, that an investor has seen there is a frequent change in the fund managers in last 2 to 3 years. So how confident we as an investor can feel considering lopsided performance of this fund for long? Is it fund manager specific, or it's the nature of the value fund itself for not delivering? Could QMF give us some insight on that?
Sure. So Quantum is a strictly process-driven organization. So, there are clearly no staff fund managers. There is no concept of that because we run it by the book. And in that sense, for anybody to come into a role, who have been groomed in the system is pretty easy because we have been following a very simple, consistent process, over the years. So that has been inculcated to us by our founder himself, who learned it from various international bodies, such as he was with the Hansberger Group, working with the Templeton, and so on and so forth. So this I wouldn't read too much into it. And the performance is a function of style. So we have much larger mandates on the offshore side, where we run the same portfolio. And they completely understand the cycle because it's a global cycle. The value underperformance during that period was a global phenomenon, and which is kind of reversing now. So in that point, I would entirely say it is that period that we're in where it was very difficult for a value manager to do well. It was very painful times, but hopefully we have come to the end of it, and our performance should improve here on.
Thanks. There is one question. Value fund should fall lower than the index during bear markets, but Quantum has been falling the same or more. Why is this so?
Yeah. So we always say that during, I assume you're referencing to the COVID fall because that was a dramatic drawdown across the industry that we are seeing. So typically we own the extremely liquid large cap names across a portfolio. So within the value category itself, if you were to think of the large cap, small cap, and mid cap split in terms of portfolio, so we would rank highly on that large cap. So it is not something that we want to. We are doing it as a process, but the fact is because there is liquidity so less in the other names, it just comes to be. So it is not something that we have mandated, but the large cap mandate just comes out in part of our portfolio construction. And from that sense, whenever a market kind of falls, so the first redemptions are largely in the liquid names, because the illiquid names are, there is no liquidity. And if a fund manager had a lot of exposure to the small cap, it would, he would not be able to liquidate those positions. It'll be high impact cost. So in the first phase of the fall, so the large cap names, especially the Quantum, which owns liquid large cap names, we can fall. But subsequently, as the bear market enters, the other stages, the fall would be less. And when we kind of jump back, and when there is a recovery, as we have seen in GFC crisis, even COVID for that matter, so the rise is also much sharper. So it is purely owning very liquid large cap names that kind of results in that fall in the initial stages. But eventually there is that support which comes from valuations, because if you were to look at our valuations versus the indices, it is much lower. So there is that valuation comfort and margin of safety that is built into as a process, which kind of is a major support, especially in the bear markets.
Thanks, there is what is the asset under management of our value investing fund? Value investing fund. That is one question.
Yeah, so we are roughly around 1,000 crores. 840, 830, 840 crores here. So it was about a month back, close to around 850, 880, and within the tax, it was around 120 crores. So close to about 1,000 crores, the domestic sector.
For an online direct fund, by what is the latest time should the funds to be transferred? Is there an option to buy, sell at a pre-specified NAV? Do we have such option here?
Sorry, can you repeat it?
Yeah. So it's basically a transaction question, like for an online direct fund, by what latest time should the funds be transferred? So the answer is 3 p.m. Before 3 p.m. the funds should be transferred. And is there an option to buy, sell a pre-specified NAV?
No, so there is no, so you will get that end of day NAV, whatever, whichever day you put in. So there is no way we can do that. Yeah.
The next question, with respect to few stocks now in QLTF, optimal valuation range, do we expect few additions of stocks in next 3 to 6 months?
Yeah, so as I was alluding, so suddenly because of this market fall, it's a time-based correction that we have seen for about a year and a half, almost now. So a lot of quality companies are also featuring into our valuations. So ideally, we should be able to pick them up, and this is across sectors. So we are quite hopeful of adding certain good names into our portfolio because many of them are coming into our valuation bands here. And this was not there in the previous cycle, especially 2016-19.
Yeah. Next question is like with new taxation of debt funds. So all your debt funds said to be affected. So with this, our AMCs are left with very few funds. So what's your view on that?
Yeah, so in a way, for debt fund particularly, this is, what I think is, Pankaj would be able to explain it better, but it is now a level playing field with respect to, all the other opportunities that are there, either fixed deposit or you put in a bank, things like that. And, but for a liquid fund, so, dynamic bond fund and liquid fund that we have, so there is that advantage that is still there. So now the regulator had made it in line with the other products that are there. So for example, the interest accruals you have to pay quarterly or monthly, however you choose it, in your bank. But for if you are invested in a debt fund, so you would have to pay it end of period whenever you redeem it at, of course, your marginal tax rate. And as a result, this would, of course, have a better compounding impact compared to your fixed deposit. So earlier, if you were to compare it, so, your debt funds would, hands down be better than your fixed deposit. But now looks like it's a level playing field, though there are certain advantages of owning a debt fund. Yeah.
So in continuation with that question, Christy, so with most of your debt funds at par with FD taxation, where does this leave your fund house funds literally? Like as an investor, we feel concerned, including your going down AUM also.
Yeah.
Are we safe or our money come growth reliable?
Yeah, sure. See, first of all, I would like to clearly state that, we were, at one point in time managing around 46 crores way back in 20. We began with 2006 with 46 crores as a AUM. And so we are far better off. We cumulatively have around 2000 crores of AUM now. And plus, the Quantum Advisors, which is our parent entity, we manage even 10 times more money than what we have in our, domestic AMC. So of course, there is the support from that. And we're also very, well capitalized. We have Fairfax, which is owned by Prem Vatsa, who is a Canadian investor, invested with us. He owns. So from a liquidity point of view, cash perspective, please don't be under, there is no issue as such. So in the sense, we're extremely well capitalized to that. Of course, we would like to see our AUM grow. And if you were to look at the growth that has happened from 2006, and you all know that we are completely direct to investors for a very long period of time. And 2016 to 19 period, unfortunately, when our underperformance came about, it coincided with the fact that, a lot of, fintech saw a meaningful rise, and their influence. But unfortunately, that was a period where our performance was not up to the mark. but hopefully, that should also change as we get more levers for growth for our AUM. But please be absolutely sure we are extremely well capitalized. Yeah.
Thanks, Rishi. Next question is based on our total expense ratio. Our total expense ratio is 1.29%, which is quite high as compared to the other well-performing funds.
Right.
Any roadmap to bring the total expense ratio to more reasonable levels? As Mr. Dogal says, cost matters in long-term investments returns.
Yeah, absolutely. I agree. And so, in fact, to just put it out there that we were the first, in that sense, to clarify on providing a roadmap for bringing down our expense ratio, even much before SEBI instituted, certain checks and balances and curtailing the management fees for the industry. So we had clearly laid it out, and you can find it in our website. So unfortunately, at the current AUM that we have, this is the minimum that is required to meet our day-to-day expenses. So further growth here on, there is a clearly defined mandate to reduce the expense ratio. So please be rest assured about that.
Are there any specific industries or sectors that value funds tend to focus on, and why?
Yeah, so we are completely sector agnostic. We do not, we have respective analysts for tracking each sector. So we have a sector-wise coverage, and everybody kind of brings in new ideas and so on and so forth. But for some reason, we have not been able to own the staple space for quite some time. And that is primarily due to valuations concern. But we are open for ideas from across sector, and we make sure that there is a constant inflow of ideas from each sector. Just that, some of our valuations filters have, curtailed us in that sense from, investing into staples, which is also kind of looks like it's a good decision on the hindsight, just looking at your 10-year growth, performance versus the index. So it's just the valuations that plays a role in it. Otherwise, but we are completely sector agnostic. Yeah.
What are some common pitfalls to avoid when investing in value funds?
Yeah, so as I said, it's very important that you truly understand the characteristic of the fund. That is, as I had put up on that slide. So it is very important that a value style clearly depicts value style irrespective of the market environment, versus the benchmark of the peers, however you want to look at it. So in that light, it is important to also see certain style drifts. So is a value manager, moving away from the value mandate because the market cycle is turning or changing? So it is very important for an investor to see that. So hence, it is crucial for one to observe that value characteristic across cycles, right? And the other pitfall is like, not from a fund perspective. Yeah, it can be even from a fund perspective that if some of the investments are becoming value traps, it is extremely important to see that there should be a definite catalyst, because a lot of companies can be just cheap. But if there is no catalyst to unlock that value, so you will never realize that value. So it is, both of these factors, just comes on top of my mind when thinking about pitfalls of value investing.
Is value buying opportunity will always be available to fund house, or most of the time we have to sit on cash? Further value investing time horizon will be how much?
Yeah. So typically the time horizon that we invest is, upwards of 3 to 5 years. Some of the stocks that have been in our portfolio much longer. There has been period of time. So cash is truly, it's not a, we don't take a cash call in a sense in our portfolios. It's a residual of, of the opportunities that we see in the market. So there are times when, the cash position really shot up, and I can just tell you the 3 times where it is marginal, it is largely, it was an outlier in the industry in that sense. One was a period between 2004 and 6 when we saw that infra boom, brick madness, and so on and so forth, where the cash positions was quite large for the, for our fund. And that was a period of underperformance. But what we subsequently saw was, all that got changed and we could deploy that cash at much reasonable valuations. And, there was a very good value unlocking. Similar is the case was when the BJP government came to power in the first time, that was 2014-15. Again, there was a marginal underperformance during that period of time, but we kind of recouped that. The only time where we were not able to recoup it was during the 2017 period, because that was the time when we went into the ground. That was a period after demonetization and so on and so forth. So the ground feedback that we got from various industries, we do a lot of channel checks, meeting management to get the feel of the respective companies. And it was very negative. And we cut our numbers sharply, each of the analysts kind of cut in their respective sectors. And if you see the consensus estimates, the earnings actually never came through until, pre-COVID. Just after the COVID is when the earnings kind of caught up. So we were right on the earnings part, but somehow there was a sudden liquidity gush in the market because of the simple fact that especially after demonetization, there was a lot of people got interested in the market. There was money being forcefully, in that sense, put into banks, eventually mutual funds. So that whole DI play came to being. And that was one period where, the cash kind of did not help us, but it is purely a residual of the opportunities that we see. So if we see, if our bottom up approach is telling us that there are no opportunities, we're happy sitting with cash. But currently, just to talk about the next 2 to 3 years, we are fairly confident, that there is some sort of an economic upcycle. There are at least signs of it. Some of these global pressures might, delayed by a quarter or two. So if you look at our current cash position, it is, less than 5%. And because that is that is what we think about the market. There are enough and more opportunities available to participate in. So yeah, so that's a kind of a long answer to that question.
Thanks, Rishi. Next question is on equity fund of funds. Is the quantum equity fund of fund focused more on growth MFs so that investors have a solution?
Yeah. So in a sense, fund of fund, we have clearly, it's not only growth. So we are trying to look at across styles. There are more than 500 plus funds that is available for a person to choose from. So we're just narrowing it down to 8 and 9. And what we are saying is that these are the most well-constructed funds. It need not be pure growth. It could, but there has to be a certain consistency across market cycles, which it has to display. And so if you were to look at the characteristic of fund and were to compare it with, let's say, a value product, it will look like a growth fund, but it will be more in line with what you see with respect to index. So, but it is an amalgamation of, various styles, be it GAR, be it growth, and so on and so forth. So I would say it is not positioned directly to be growth. It is more on the lines of being consistent across market cycle, the performance being consistent, and not taking, undue risk in the portfolio, either via a small cap exposure or, or seen large drawdowns and so on and so forth. And of course, consistent fund managers. So this is, some of the consideration that goes behind choosing that fund of fund. Yeah. There is no growth mandate as such.
Thanks, Rishi. Most fund performance are near about the index, Sensex or Nifty. So investing in an index fund would be better than with much lesser total expense ratio?
Yeah, so honestly, if you were to look at the performance since 2016 onwards, if you were to look at it, somehow prior to that, if you were to do the number crunching, most of the active funds were able to beat the benchmark. But somehow that outperformance has been, eroded if you were to look, the period ensuing. So just looking at, active versus passive, one investor can conclude that, it is lower expense ratio, hence go for passive. But there are some pitfalls to it. So, one, we think India is still some time away from, getting into pure, passive management, as we have seen in some cases like developed markets, where it is extremely difficult to beat the index because, of course, the expense ratio has a impact, but the market is very efficient, and that ratio is really bad in the West. And then there are enough and more regulatory interventions that make sure that the index is also properly constructed. Here we find a lot of companies that which you can say are politically connected, are type of crony capitalists, which find their way into the indexes. I'm not saying it will not do well. It can do well. It has done well for some period of time. It had hurt our performance. So if you're okay with taking such risks, because we never know when those risks will unfold, right? It could be 1 year, 2 year, 3 years. So, but they are large constituent of the index, whichever index you were to take it. So there are such risks which are there, which we think an active management can take away. And see, as I said that there was a period where, this, especially after 16, there was this liquidity injection into the system wherein, the top indices, there was a very concentrated rally that we saw for a very long time, so it was a self-fulfilling prophecy in that sense. If you're in the index, you will get more flows, and that lifts your NAV and so on and so forth. So we think we are in a way somewhere at the end of it. It's not completely gone, but the next, there is a cost of capital to that. So we will not see such abnormal reactions that we saw during that period of time. That it is at least our thesis. So this is a period where active can do better, but let's wait and watch. It's it's too early to comment.
Thanks, Srishti. We'll request all listeners to post their questions if they have any. Srishti, next question would be like, currently my portfolio is heavy on value. Do you think I should trim my allocation towards value and shift my equity allocation to growth style?
Yeah, so see, it all depends on your risk appetite. So we always advocate having exposure to multi-faceted funds, in the sense like across various styles. That is in our that is why we have around 70% exposure within our equity basket to fund of fund, which gives the investor access to multiple types of investments. It's a curated set of, and here we are kind of paying our management fees to other managers. Quantum is just taking a fraction. So in a way, because we know that is good for an investor to be diversified across category of funds. So I would request the investor to be well diversified across categories. But that said, see, so for somebody who understands value, for a person who's okay with a period of underperformance, because eventually things will improve, because we know all of these things are cyclical. For example, for me or for some of my colleagues here at Quantum, so we are very convinced of value as a strategy. So we have bulk of our investments in value as a category, right? So if you are in that category, then you are fine with having this exposure. But if you feel, if you want to have that well-diversified set of exposure, so please go ahead and explore our fund of fund, or any other very well-diversified fund in the market. Yeah.
As this seems right time for value investing, still what is optimum, like lump sum or SIP?
Yeah, so we always recommend having a staggered approach to investing, because the market is not like dirt cheap, in the sense like something like what we had after COVID fall, where you can put lump sum in that sense. So we would request an investor to gradually build up his position, because there are so many uncertainties, that some things we can see, something we cannot see. So it is always recommended to have a staggered way of approach over a period of time. So market absolutely is by no stretch extremely cheap, to do lump sum.
This is basically a question on expense ratio. Does FOF charge twice the expense ratio?
Yeah, so I'm forgetting the exact number, but we pass on, so there is a, we can get that expense ratio in our fact sheet. So I think Quantum takes about 0.5% of that expense ratio, and then there is the underlying fund managers fees. So we try and minimize that also. So we think it's a very reasonable amount. I think your total expense ratio is not more than 1% or 1.1%. So we can just get that checked in fact sheet. So it is comparable to any other funds in that category. So we want to be able to. So this is the fees that we take for curating that set of funds. So we try and go and meet the management, meet the fund manager. Chirag does that quite often, and yeah. So it's the minimal that we charge to be able to run the fund and to do all that research work that is required.
Any more questions all our listeners would like to post? Yeah, the question has come like taxation for quantum equity fund is a huge issue. Any thoughts on that?
Yeah, so it was actually quite unfortunate that something which is an equity category, the regulators just chose to do away with, treating it as a pure debt fund with no indexation. So the only thing that it has been our endeavor to give an investor a research-backed approach to investing across mutual funds. So if you feel that service is getting fulfilled, so please feel free to invest. And we are also working in trying to make this the most tax efficient. So there are certain processes which are underway. But unfortunately, it is this is a completely equity fund. We get exposure to all the equity fund, but it is taxed like a debt fund with no indexation benefit. So yeah, so that is my broader thought. So we are working on trying to improve the tax efficiency part of it. Yeah, so you'll hear from us in some time.
There's a question that your view on gold or multi-asset fund or dynamic balance advantage fund for new investments.
Yeah, so gold, we have always maintained we should look at it like a insurance. We are hoping that when investing in gold, investors should not be thinking about immediate returns. It is like, let's say, if the world falls apart, this is one, because one source where you can still garner some returns, because it is highly uncorrelated with respect to equity, negatively correlated with equity. So gold functions in your portfolio as a pure diversifier. We have always maintained in terms of our debt funds that we should be looking to park our immediate needs where we immediate needs 9-10 months of expenses or any other immediate needs in a liquid fund. Dynamic bond fund is again it is exposed to duration risk in that sense, and the performance has been good. We have been able to we have completely avoided taking credit risk. So we have avoided taking credit risk in that sense. So this is also an opportunity, but there is a commensurate risk which comes with that. So if your orientation is slightly long term, so then you can look at dynamic bond fund. But for immediate money parking or immediate need, please invest in liquid fund that is much safer, and gold is a diversifier.
I think we can take a last question. Your views, what would be the advantage or disadvantage of equal weight index funds? Any comments on that?
So it's, I know there have been some models which have been, going around, but it just, so I'll probably talk about how we go about portfolio construction process in terms of weights, and then try and compare it with equal weight. So typically we end up, the smallest position that we can ever take is a 2% position in any stock. And if there are certain qualitative filters that we bring in, trying to gauge whether this 2% position can be 4% or can be 6%. 6% is where we cap it at cost to any NAV. Now, the considerations that goes behind getting that to a higher weight is the management quality, then the quality of earnings, then it can display the predictability and so on and so forth. So that gives us a confidence in making a certain stock a 6% position or a a larger position, and we kind of cap it at 10% of market weight to the to the total flows if it goes beyond 10%. So that is also a cap. So now the equal weight portfolio can be a good way, but it does not display any conviction on the stock. You can just you can of course construct it. It's a different type of construction. You can just construct it where you're not really actively engaged in making or increasing or decreasing weights, and you let it run and see the results. So the weights in the portfolio are a clear reflection of the relative conviction that you have on the stock, which to me is not served by having an equal weight. But that does not take away, the performance or anything on those parameters. It might well do extremely well. So it's just a different way of doing things. There are a lot of portfolio construction process. Yeah.
So with this, we'll end our Q&A session. Christy, any closing comments from your side?
Yeah. So thanks investors for taking time to join our webinar. Extremely happy to have interacted with some of you. So as I was saying, that looks like value. This current macro environment is conducive for value as a style, and and then slowly we should see our performance improve, because we think our portfolios are having better names and in a sense also extremely well positioned for the economic upcycle, even as India goes through it over the next 2-3 years. So happy and safe investment journey ahead for all of you. Thank you.
Thank you for your valuable comments. To know more about our asset allocation solutions, we'll request all our listeners to visit our website, that is www.quantumamc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumamc.com, and we'll be happy to answer the same. Once again, thank you everyone for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.